Right. So, yes, the question number 4, looking at the structure, you know that is going to be statement of financial position, isn't it? So, looking at the structure, it is going to be statement of financial position. Okay. So, who is going to be our parent here?
Diamond.
Okay. So, since it's going to be statement of financial position, go and do your everything and put the figures of that more into the statement of financial position before any other figures that will be coming. So let's have Diamond Group. Okay. So let's have the Diamond Group consolidated statement of financial position assets. What is the date? Okay, 31st March. 31st March 2017. So you have your assets, then you have the non-current assets. Okay. So you have the PP. What is the PP figure?
$10.62.
Okay, 1062.
10,
Okay. What is your next item? So you have the investment in subsidiaries. So that is the purchase consideration that will be canceling out with the equity items of the subsidiary at acquisition date. So we are going to be bringing goodwill as a resulting figure from that. Okay. So they have investment in Heart. That will be maybe investment in associates. So we are going to be having investments in Heart. So we bring that figure there. How much is it?
$68.
8.
So we have other financial assets. For the parent is how much?
190.
190. So you can leave like maybe 2 additional spaces because we don't know what will be coming. So maybe we can just go to your current assets there. So let's see the current asset and see whether if we are giving only one figure. Okay. Since we are giving only one figure, we can write that figure under this. So let's come to current assets. Okay, what is the parent figure for current assets?
885.
885. Okay. So let's go to equity and liabilities. Okay. So we have the share capital for the parent. Okay. What is their share capital?
1,650.
650. So their retained earnings we do working. Do they have other components of equity?
Yes, please.
Okay. Other components of equity. Then we have the non-controlling interest here. Okay. So we have the non-current liabilities. Non-current liability. Were they giving items or?
No, it's only one.
Okay. So that would be 1143. 1143. And current liabilities. Current liabilities, how much?
172.
172. Okay. So you can, from this place, you can now move on to your workings. Okay. You have to do all these things before you start reading the footnotes. Because some of the footnotes, if you don't know, you start reading, you see an item, it will scare you and your vim will be down. So do the things that are going to boost your confidence before you move on. So you have your group structure, then we have the net assets. Okay, it is likely that we are going to be having two subsidiaries. So you can do the net assets for, okay, you can do the net asset for the two. So let's bring the first one here. Let's come to the net assets for the second one. Okay, so let's have at acquisition here and at reporting. Okay, so at acquisition and at reporting. So yes, so you do this. Even if you can get a figure straightforward, you can even bring some of the figures before we move on to the next one. But since we are here to read the footnotes, then let's just create the columns for them. Okay. Then you come to goodwill, calculation of goodwill. So you have goodwill calculation. You do the goodwill calculation for all the two. Okay, and just put the figure together. Okay. So we can say that our goodwill calculation for the two can be here. So maybe we can start with our non-controlling interest here. So this one you can scan through the footnotes to pick these items. Some of them they will give it to you direct. Some of them they will say they are going to be proportionate. So you have to wait to do your net asset before you determine your non-controlling interest. So the non-controlling interest too, since it's going to be we are going to put the two non-controlling interests together to have one. Okay. So since it's going to be two, you can leave, like, just look at the space and you can come to group retained earnings here. So we can come to group retained earnings here. Okay. So this group retained earnings, okay, looking at the space, we can have our group other components of equity here. Okay. So these are the major things that you are going to be doing the workings for. So you can create a column for them and move on. Okay. So after doing that, you can now see whether you can attempt some of the footnotes. Okay. So let's look at the first one. Roxanne, are you there?
Yeah.
Okay. Read the footnote for us.
Okay. On 1 April 2016, Diamond acquired 70% of the equity interest of Spade, paying cash of $1,140 million. At 1 April 2016, the retained earnings and the other components of equity of Spade were $780 million and $64 million, respectively. The fair value The fair value of the identifiable net asset of Spade at 1 April 2016 was $1,600 million. It is the group's policy to value non-controlling interest at fair value, and at the date of acquisition, this was $485 million. The excess in the fair value of the identifiable net asset is due to a non-depreciable land.
Okay, so we done one. This you can just scan through and see whether there is a disposal of any subsidiary. No, there is no disposal. So we know that from 1st April 2016, Diamond acquired 70% of Speed. So Speed is a subsidiary of Diamond from 1st April 2016. But we are doing this for 31st March. So it means that they are still a subsidiary of Diamond. So what you do is that go and consolidate their items also. So we are going to consolidate the items of Roland as well. So what is their PPE figure?
1210.
Okay, 1210. Okay. What is their other financial assets? What is the figure
They
for
don't
them?
have it. They are not happy.
They don't have. Okay.
Yes.
So that will be dash for them. What about their current assets?
782.
782. So let's come to their none of their equity items will come here. So their non-current liability figure is what?
125.
Okay, 125. Their current
Sorry, that is
That
189. 189.
Okay,
current.
189. Okay. And their current liabilities figure is what?
That's
One.
125.
125. Okay. So we have done a consolidation for them. We can now go and do net asset for them. Okay. So we have their share capital. Share capital. So let's go to the statement of financial position and pick their share capital. What is their share capital?
720.
Okay. 720 at acquisition and also at reporting. Okay. So we want the percentage holding to be the same. So there will not be any issue of new shares. I've said that yesterday. So we have the retained earnings. So the question has given us the retained earnings at acquisition and also the other components of equity at acquisition. So let's go and pick those figures for them. Their retained earnings at acquisition is how much?
780.
780. So we have 780 against what?
Against 880.
Okay, 880. So their other components of equity was 64 against what?
64 against 78.
78. Okay. They have given us their non-controlling interest. You can see that we have also been given the purchase consideration, isn't it? Okay. So you can bring the purchase consideration. How much are they paying? And what is the portion of the net asset they are buying at this date? So I'm sure this is
1,140.
1140. So they have given us the non-controlling interest too. Okay. So you have your fair value. So you have your Speed here at acquisition. 485. Okay. So since they are using fair value, it means that they are using full goodwill method for so they have given us the net asset, isn't it? They have given us the closing balance for the net assets. Their net asset at acquisition date.
Yes.
Okay. And that is 1,600. Okay. That is the net asset. But that net asset is for both the parent and the NCI. So what is the parent portion? 1,600 minus 485. What are we having?
1115.
Okay. So the portion of the net asset that the parent is buying is 1185. What will be the goodwill?
$45.
Is it 45 or
25.
25? All right.
$25.
So you can also calculate by adding the NCI. Why are you adding the NCI? Because the NCI is already here. You have to subtract the NCI. So just add and bring all the 1,600. You'll be getting the 25 as a good job. Okay. So let's come to this place. What's supposed to be their net asset at acquisition? The net asset that we are calculating from their books. What's supposed to be the net asset figure from their books at acquisition? 720 plus 780 plus 64.
1564.
Okay, so what is the difference? They are now saying that it's 1,600. So what is the difference?
Break
336.
it down with it.
Okay, the difference is 36, isn't it? I'm guessing 36.
Yeah, it's 36.
Okay, and they say that 36 is due to what? The excess in fair value of the identifiable net asset is due to non-depreciable land.
Land.
Okay, so it means that the value of land has increased. Let me bring the land over here, 36. So that will also be 36 at acquisition because we are not depreciating. So the value at acquisition will be the same as at reporting. If this should be a depreciable item, it means that you are going to use you are recognizing the 36 on 1st April 2016. But this is 31 March 2017. We have done 1 year already. So 1 year of the value has been consumed. So we have to look for the depreciation on that. But this is a non-depreciable item. So you come here, your PP will increase by 36 because this has not been recognized. Okay. Sometimes the question will tell you that the fair value adjustment has been taken into consideration already. What does it mean? The fair value adjustment will only be recognized after acquisition. So you only bring the 36 at acquisition and leave this one as dash because they say that it has already been taken into consideration, meaning that they have recognized the 36 into the post-acquisition figure. Okay, but this one they have not told us anything. So it means that it has not been completely recorded. So we are going to do the recording for them. So if asset is increasing, liability is constant. Our equity will be increasing, or our capital will be increasing. The same time, our asset will be increasing. That's why we are increasing the net asset by 36, and also the asset will also increase by 36. All right. So
Hello, sir.
yes, please.
You were saying something like assuming that the fair value was a depreciable asset and it
Yes.
has already been incorporated. So with that one, it means it's only the depreciation that you factor.
No. If they say it has already been incorporated, it means that the depreciation has also been done. Everything about that particular transaction has been done.
Okay.
All right. So you only bring the figure at acquisition. The incorporation will be done after the acquisition date. So everything will be during post-acquisition period. It means that they have done everything concerning that. So you only bring the fair value at acquisition for them. And that is all. You won't do anything again because the value has been adjusted against the PPE. Okay. But since they are silent about that, it means that they haven't recorded this in their books and you are coming to do the right entries for them. Okay. So let's come to, I'm sure that from holding that footnotes, you can get about, yes, you can get a group structure there. You can get a purchase consideration, the net assets. You can also get the NCI. So maybe at least yesterday I said that the maximum number of ticks that you'll be getting to have all the 20 marks is the maximum is like 80 ticks. So if you're able to get the 80 ticks, they can give you the full 20 marks. Or sometimes they can increase it to depending on the question, but the maximum, okay, the minimum is 80. Let's say the minimum is 80. Mostly it is 80, it cannot be more than the 80. So just try your best and see if you can get the 80 ticks over there. Okay.
Hello, sir.
Yes, yeah.
I think we'll be very happy if you can maybe give us a clue of how the text is going to be done, like the items will be taken.
I've shared that on the page some time ago. I don't think I have it on my phone again. I have to check again.
Oh, okay. Thank you very much, sir.
All right. So we are done with the first footnote, and let's see how okay. So, but I can give you maybe a fair idea about the ticks. Okay, they will mark all these figures one, like they will just mark them 1, 1, 1, 1. Okay, so this one too, they will mark this one 1, 1, 1, 1. Then they'll mark the figures that you put in bracket 1, 1, 1, 1 plus the final figures. So this will take 1, 1, 1 plus the final figures plus some of the workings. Okay, but the minimum is 80. Sometimes it can also be 120 depending on the nature of the question. Okay, so let's come to the
Sir,
yes, please.
sir,
I can hear
please,
you.
I would suggest that when we are doing the next this in complex group, maybe when we are doing the question at all, in respect of the group structure, I would suggest that you use one example, because the examination condition, sometimes you may think you know, but it will surprise you. So you just do how you are going to recommend it for us in examination condition.
I've
The group
done group,
structure.
I've done group structure yesterday.
No, like how to demonstrate it.
Oh, I've done group structure. So
In the complex group.
we have the
Okay.
example that we solved yesterday was complex group, and I have done group structure.
Okay. That was a bit straightforward, small. Okay, thank you.
It's not about how you are going to make the thing look beautiful, senior. They are whether you can make the working everything beautiful, but nothing will come out of it. Just you are not writing like you are not in your own room trying to write so that you say, okay, the handwriting is not nice. They know that you are working under pressure. So nobody is going to, you don't know. Sometimes you even read you read what you have written, you yourself, you will not even understand what you're writing. But you can't do anything about it. Just have to move on. That is left with the examiner. He will try. It's his job. So this is a condition. Let's take the B. So
Okay, thank you.
On 1 April 2015, Diamond acquired 40% of the equity interest of Club for cash consideration of $420 million. At this date, the carrying amount and the fair value of the identifiable net assets of Club was $1,032 million. Diamond treated Club as an associate and equity accounted for Club up to 31 March 2016. On 1 April 2016, Diamond took control of Club, acquiring a further 45% interest for the cash of $500 million and added this amount to the carrying amount of its investment in Club. On 1 April 2016, the retained earnings and the other components of equity of Club were $293 million and $59 million, respectively, and the fair value of the identifiable net asset was $1,062 million. The difference between the carrying amount and the fair value was in relation to a plant with a remaining useful life of 5 years. The share price of Diamond and Club were $5 and $1.6 respectively on 1 April 2016. The fair value of the original 40% holding and the fair value of the non-controlling interest should both be estimated using market value of the shares.
okay, assembly. So right. Okay, let's come to this one. Let's come to the investment. You can say the investment in spade. It's actually 1,040, isn't it? Okay. So that will be
Yes.
canceling. But the investment in club now is 928. Okay. That 928, they are saying that they have added the new addition. How much is the new figure now? The 45% that they acquired.
And they are paying 500 for it.
Okay. So they say the 500 has been added to what? To the carrying value. They have equity accounted for this one. So it means that the 420, they have added profit, they have subtracted dividend. How we do investment in associates. So they have added a certain figure to it. And now we are having, if you add a 500 to that particular figure, we are having 928. So it means that the 420, which was the initial amount, has increased by 8. Is that correct? They
Yes,
paid
please.
420. Okay. So it means that the carrying value of the initial 40% is now 428. Okay. Let's come here. When are we going to start consolidating? Uh,
1st April 2016.
okay. So we start consolidating them from 1st April 2016 because that was the day that control is being what? Achieved. Okay. So let's go and do their net asset at that date and we come to the remaining things that we're supposed to do for them. Okay. So this will be for club. This will be for club. Okay. So we have their share capital.
$700.
Okay. 700. This will also be 700. Okay, let me the group structure now. Let me show the group structure now. Damo is the parent. Okay. So Damo will be having, okay, so you can just do something like this. Okay. So Damo will be having speed over here. So Damo is having speed 70%. I'm sure it's 70%, isn't it? Okay. And club will be what?
The
Club will
first
be,
acquisition was 40.
you just put all the total there, but you can come and show that how you have gotten the what? The
Okay.
85. Okay. So you look at the date of acquisition now. So date of acquisition of these people, you write their date of acquisition, you write the reporting date and the post-acquisition period. These people, if you come over here, you do the first one. So maybe the first one was maybe 1st April. We are just using that was 40%. So you write the date here, 1st April 2016 or 2017. Then you come to the second acquisition. That was also 1st April. So 45%. Then you put it together and have. There is no format for this one. The only thing is, if you're able to, they are only interested in the percentage. Okay. So just show the percentage. That is it. So you can also say, okay, you can write spade first, parent or diamond, 70%, NCI, 30%. You come to club, parent, 85%, NCI, 15%, date of acquisition, reporting date, post-acquisition period. That is all. So you can just write it under speed. Then you have diamond, 70%, NCI, 30%, date of acquisition, reporting date, post-acquisition period. You come to club, parents, 85%, or diamond, 85%, NCI, 15%, date of acquisition. That's all. So you don't have to do anything nice we have a lot of things to do than making it look nice. Okay. Within the 3 hours, we have a lot of things to do than making it look nice for the examiner. He is going to be paid, so you should also suffer to read certain things. Okay. So let's look at what is their NCI at the time control is being achieved. Okay, they are asking us to do the NCI. Okay, let's come to group return. Let's come to return earnings. What is their return earnings at the date of acquisition?
293.
Okay, 293. So we have 293 against what?
364.
Okay, against 364 at reporting. So other component of equity was
59.
5959.
Mm.
Okay, so there is no movement in that. Okay, what is the figure they are giving to us as the net assets at that date?
That's 1062.
Okay, so 1062. The question is, from their books, based on the information given to us, what's supposed to be their net assets?
$1,052. 1,052.
Okay, but they are saying that it is now 1062, isn't it?
Yes.
Okay, so there is an increment of what?
10.
Okay, and they say that 10 is due to the 10 is what? It's a depreciable item, isn't it? All right. Then they are saying that the difference between the carrying amount and the fair value was in relation to plants with a remaining useful life of 5 years. Okay, so the 10 that is coming over there is plants. Okay, it's plants. And this plant is having a remaining useful life of 5 years. When are we having plants in the books? When are we having the plants in the books of CLAP? When are we recording this? At what date?
The plant will be there from the first acquisition. That's 1st April 2015.
No.
No,
First,
it will be in 2016.
yeah, we don't have control over them. You only do fair value adjustment if you have control. Okay, so the plans will be there from 1st April 2016. That is where we are having the plans in the books now. Our reporting date is now 31 March 2017. The value cannot be 10 again because we have used 1 year out of that. So you do so I'll show all the 10, then I'll bring depreciation here. Okay, so I'll bring additional depreciation. Okay, this depreciation is coming in as a result of so let me have additional depreciation, or let me just put depreciation here for you to know. So this will be depreciated for 1 year, so 10 over 5. What are we having? That will be 2.
2.
All right. The depreciation should be taken from post-acquisition or profits. So we come here and have the 10. For the purpose of ticks, add the 10 first and take the depreciation from it. Don't bring the 8 unless you have done workings to get the 8. Okay. But if you bring only 8, it means that you are going to be losing a tick there. So add a 10 and subtract your depreciation from it. Okay. But if you have done workings to get the 8 already, then just bring the 8 over here because the ticks will be awarded to that particular workings there. Okay. So let's come to their net assets at reporting at acquisition date. We have gotten that now, 1062. But let's come to their purchase consideration. So goodwill for CLAP. Okay. So the question is asking us to use the fair value to determine their non-controlling interest and other issues there. Okay. At acquisition date, what will be the percentage for the non-controlling interest? At acquisition date,
60.
15.
that will be 15. Please consolidate everything about consolidation start from the day that control is being achieved. Okay. The first time that we bought 40, we are not parents, so we can't call the 60% a controlling interest. They are the people with the controlling interest, so they cannot be called non-controlling interest. We are the non-controlling interest. The time that we have the 40% holding. But now we have acquired 15%. We are now having a majority of the control. So now the remaining 15% can now be termed as what? The portion of the equity shares that we are now controlling. So consolidation, everything starts from the date that control is being achieved. That will be 1st April 2016. And from 1st April, the parent is having 85%. 15% will now be the non-controlling interest. Let's come here. 15% of what? 15% of their equity shares. Okay. What is the number of shares that the club is having? What is the number of shares that they are having?
700 million.
Okay. So they are having 700 million shares. Okay. 15% of this is for the NCI. So let's go and calculate their NCI for them. So we have the fair value. The fair value will be 0.15 multiplied by 700 multiplied by their share price. The 0.15 multiplied by 700 is the number of shares that belongs to the NCI. Okay. But these shares are trading at what? At what figure? What is the share price of the subsidiary club? What is their share price?
I think all of them is $1. $1.60.
No. Yes, it's one. So that is the current market price now. So you look at the number of shares multiplied by 1.60. What are we having?
168.
168. Okay. So that is the NCI 168. Okay. They are asking us to calculate the what? They are asking us to calculate the fair value of the original 40% also using the market value, like the NCI. Okay. We know that they are having what? 700 as the number of shares, isn't it? Okay. So if they are having 700 as the number of shares, we have acquired 40% of them. So let's look at the fair value.
Yes, sir.
Yes, please.
The number of shares is not 720.
No, please. That is the first subsidiary. We are looking for club.
Oh, okay. Thank you.
Okay. All right. Fair value of the original 40%. So we look at that now. Okay. So we look at our holding. The holding will be 0.4 multiplied by 700. Is that correct?
Yes.
Okay. So then this answer multiplied by the share price at the date of acquisition. How much are we having?
$448.
448. Okay. But what is the value of our 40% at the date of acquisition? What is the carrying value? We have determined that. The carrying value is what?
Sir, please. So. Hello.
Yeah, I'm with you.
Yeah, please go to the fair value aspects where we calculated the 40%
Okay.
for the initial. Please, why are we using the 1.6? Because as at the very first day they bought the 40%, the share price was 1.6.
Okay. The share price of Damo and Club were $5 and 1.6
That is their fair value.
respectively on 1st April 2016. The fair value of the original
Okay.
40% and the fair value of the
Okay.
controlling
I get it
interest
now.
should both be estimated using the market value of the share price. Okay. If
Okay,
you are
thank
doing
you.
acquisition in stages, okay, at the time that you are getting a control, you need to find the fair value of your original holding. That's what we are looking for. So what is the fair value of the 40% at the time that we have obtained control? The carrying value is 428. We have determined that by subtracting the 500 from the 928 there. So we have subtracted the 500 from the 928 here, and we say that the 40% is 428 in their books. Okay. Now the fair value is what? 448. What is happening there? Okay. So we have the purchase consideration for them now. Purchase consideration for the parents. Purchase consideration for the parents will now be 500 plus 448. Okay, how much are we having?
$948.
Okay. The fair value, the value of the original 40% has increased by what?
$20.
It has increased by 20. That will be taken to return earnings. Let's get a parents return earnings there. That will be 1180. So 1180. The increment over there will be 20. So we have 428 in our books. They are now saying that the value is 448. It means that the value has increased by 20. So the 20 will be a gain for us. This is not the first time that we are doing this. We have done this like two times already, and you should be familiar with this. Okay, so let's come to their. So which one? Should I use the same method I use for calculating the goodwill over here, or I should add the NCI?
Let's add the NCI.
Okay. So we have the NCI of how much? The NCI for them is 168. Okay. So what will be the total? And we have the net assets. The net asset is 1062.
The total is 1116.
Okay. 1116. So what is a goodwill? Okay. I'm having 54.
Yes, 54.
Okay. So we are okay. So one footnote is giving you like a lot of things. Okay. So we are done with the NCR. We are done with the net asset too. Let's see what will happen. Okay. Yeah. C.
Diamond has owned a 25 equity interest in HAT.
Right.
Yeah, but
We've not consolidated the.
oh, sorry. Okay. So it means that Diamond must be consolidated as well. Thank you. So what is their PP figure?
1,265.
1,265. Okay, 1,265. Okay.
Current assets.
They don't have other financial assets. Okay.
No, please.
Current is what?
224.
224. Okay. Their
Liabilities.
okay.
Long term, non-current liabilities is 172.
172. And the short is
194.
194. Okay. So yes, thank you. All right. Yeah.
Diamond has owned a 25% equity interest in HAT for a number of years. HAT had profit for the year ended 31 March 2017 of $20 million, which can be assumed to have accrued evenly. HAT does not have any other comprehensive income. On 30 September 2016, Diamond sold a 10% equity interest for cash of $42 million. Diamond was unsure of how to treat the disposal and so has deducted the proceeds from the carrying amount of the investment at 1 April 2016, which was $110 million, calculated using the equity accounting method. The fair value of the remaining 15% shareholdings was estimated to be $65 million at 30 September 2016 and $67 million at 31 March 2017. Diamond no longer exercises significant influence and has designated the remaining shareholding as fair value through other comprehensive income.
Okay, this one they don't have to. Okay, sometimes you can have less than 20% and still have a significant influence. But this one, since you are having 15% now, even if they are not adding anything, okay, the best assumption is that they are going to be classifying this as what? As a financial asset. So you can see that they are classifying this as a financial asset through other comprehensive income. For financial asset through equity instruments, we have only two classifications: profit or loss, or other comprehensive income. Okay, but the question is not about that one. Okay, are they going to be classifying this as disposal? Would this be considered as disposal? Would this be classified as disposal? Are we going to
Yes.
be classifying this as disposal?
Yes, please.
Why?
Because the majority interest is sold.
Okay, so if you come to group accounting, any transaction in relation to disposal that is going to change the classification of the initial recognized what item or investment, it should be classified as what? As disposal. If it is not a disposal, we should still be having an associate. Okay. If we are doing disposal of subsidiary, if we have 70% and we sold 15%, we are going to be having 55. It will still be classified as subsidiary. So that is not a disposal. But situation where we are now going to be losing control and now be classifying the investment as a different classification, that will be a disposal. Okay. You have 25%, which is a significant influence, and you have sold 10%. You are now having 15%. It means that you are not having influence again. So this will now be reclassified. So you have sold your investment and you are now classifying it as what? As fair value through other comprehensive income. Okay. Now, what is the value of the asset? What is the value of the initial 25%? And when was the disposal done? Okay. When was the disposal done? Okay. When was the disposal? When? When was the date of disposal?
That's 30th September.
Okay. Okay. That was 30th September 2016. Okay. They said Diamond was unsure of how to treat the disposal and so has deducted the proceeds from the carrying amount of the investment at 1st April 2016, which was 110, calculated using the accounting, equity accounting method. So let's go now here. Let's go here. What is the investment in heart here? What is the value for investment in heart?
68.
So add a 42 to it and see whether you have the 110.
Yeah.
Okay. Okay. So let's come to this one. So let's come to, this is very simple. You don't have to stress yourself. Okay. All right. So let's come to investment in heart. Okay. Or disposal of investment in heart. Okay. Let's come to disposal of.
Hello, sir.
Yes, please.
Please, I wanted to know the reason behind coming to check the investment on how to just determine, like, what are we determining at that point? I wanted to.
Yeah.
We came to that, the 42
Yeah.
to get the 110. I wanted to please know the reason behind it.
They can charge the profit for the year to it. You see, they have made a profit, isn't it?
Yes, please.
Okay, they have made a profit, so the profit can be charged to that particular figure. Okay, so we want to know the figure. So the profit of 20, they can take their share of the profit to that one, so that you know if the profit is already added, you know how to adjust the figure to know your disposal at that particular date.
Okay.
Okay. And you can also do that to check whether the investment has impaired. There can also be an impairment of the investment in the associate. So you can also
All
check.
right.
Uh,
All right.
so let's come to the carrying value of this. Okay. Carrying value of this at the beginning of the year, April 2016. They are saying that is what? 1110, isn't it? Okay.
Mm.
So the disposal was 30th September 2016. Okay. So it means that how many months after the start of the year before the disposal was done?
6 months.
Okay. 6 months. So it means that our investment must increase by 6 months share of profit. So let's count to the share of the associate profit. So share of their profit. They are saying that the profit is what? Is 20.
My profit is 20 million.
So which has accrued evenly throughout the year, isn't it? So we have 6/12. So that will be 0.5 multiplied by 20. Now multiplied by our shareholding. So we find the 6-month profit and find our portion of it. So the profit is 20 for the whole year. And they are saying that we should assume that it has accrued evenly throughout the year. So it means that every month the same profit. So if you have done 6 months before the disposal, what is the profit of the associate for the 6 months? That will be 6/12 multiplied by the 20. Okay. And that will give us 10. And we are having only 25% share of this because from that date, from the starting date to the disposal date, we are still having 25%. So what will be our share of their profit for the 6 months? 0.25 multiplied.
2.5.
Okay. So that will be 2.5. Okay. So the value of the investment at disposal will be how much? The value of the investment at the date of disposal will be the value at the beginning plus the profit, which will give us 112.5. Is that correct?
Yes, please.
Okay. How much are we selling out of this?
42.
No, we are selling 10% out of that, isn't it?
Oh, okay, yes.
Okay. So if you are not giving the value of the interest, it means that you just find 10%, you do 10/25 multiplied by that figure. If you are not giving the value of the remaining interest, okay, you are selling 10%, remaining 15%. Let's come here and see whether they have given us the 15%, the fair value of the 15% at the date of disposal. Come here. The fair value of the remaining 15% was estimated to be 65 million at 30th September 2016. So it means that the 15% is what? Is 65 million at the date of disposal. So this particular figure over here is 25%, is for 25%. They are saying that 15% at this date is 65 million. So what would be the value of the 10% that we are selling?
$47.5.
47.5.
0.5.
Okay. So let me just calculate the carrying value of the disposal, or let me just do it over here. So let me have the fair value of the 15%. So fair value of the 15%, we take it from this one, which is 65. Then we now have 47.5. What is the process? How much are we receiving? How much was received?
42.
Okay. So what are they making? They
5.5.
they are making
5.5.
they are making a loss of what?
5.5.
Okay. So that loss should be taken to their retained earnings, loss on disposal of hats. That will be 5.5. Okay. So, but we are going to be bringing the share of the profit here. They haven't accounted for the share of the profits, the share of hard profit for the first 6 months. That has not been accounted for. So 0.5 multiplied by 20 multiplied by 0.25. I'm sure that is 2.5, isn't it? Okay. They haven't accounted for the share of the profit. That's why they are having the opening balance of 110 as at this date, as at the reporting date. So the share for 6 months should come here. The loss on disposal should also come here. But let's come to we have done this one now. Let's come to the fair value of the remaining 15%. At the date of disposal, it was 65. But at the reporting date, it is now how much?
67.
It is 67. That has increased by what?
By 2.
Okay. So that too will be recognized in other components of equity because this is being classified through. So let's have the parent other component of equity there. How much is it?
128.
128. Okay. So we have the fair value gain of 67 minus 65 on the investment of the 15% in HAT. Okay. Let's come here. Investment in HAT should be derecognized, isn't it? Investment in HAT should be what? Removed from the books because we are not going to be having investment in associate again. So what will happen? You bring your what? You take your 68 over here. Then you come and add what? 67 here. Are we okay with that treatment?
No, sir.
Okay.
Yes, sir.
Let me come here. Okay. What are we going to be doing? Let's add a 42 back. Okay. The 42 should not be credited. The 42 should be treated as a disposal. We have done that now. We have gotten what? We have gotten 5.5 on the loss, on the disposal, which is a loss. Okay. Now, if we bring this particular figure over here, what will happen? It will now be 110, isn't it?
Yes.
Okay. So this 110, we have disposed of how much? We have disposed of 47.5. Okay, let's add a 2.5, which will be the share of the profit also. Okay, 2.5. Then we have disposed 47.5 out of this. What will be the remaining figure?
$65.
Okay, we'll be having 65 over here, isn't it? Okay, so this 65 should be removed and transferred to other financial assets. Okay, so we bring the 65 over here. Okay, but this 65 has also increased by what? By 2. So we'll be having 67. That's what we have done. Okay, we don't have to do these plenty things because you have done all of these things in your workings already. You have gotten the 4.7. You have gotten the 47.5. You have gotten the 2.5. You have done the treatment for this one already. You don't have to waste time over here. So the best thing is that, okay, what is the carrying value on the investment now? What is the carrying value in that particular investment in HAT? It is 68. We are derecognizing. We are removing the investment. We don't have investment in associated again. Okay, so we are removing this one. Come and subtract the 68. Okay, if you are removing, what is the fair value of the remaining 15% at the reporting date? It's 67. So just come and add the 67 here and move on. That's what we are doing. All right. So there is no cause for alarm. You just have to stay within your limits and move on. Okay. So I'm sure we are done with the C part now. D. D. Rocks, now you there? Okay. Roxanne is not there. All right. Goodwill has been reviewed for impairment and no impairment was deemed what necessary. After hearing this particular statement, it means that no impairment will be on your goodwill. Go and put your goodwill figures. We have 25 over here. We have 54 over here. So you have your goodwill now. You have 25 plus 54. You put all of them together to have a total goodwill for them. So 25 plus 54. Okay. So that is for that particular one also. Let's come to the E. Roxanne, are you there?
Yeah.
Okay. Continue your work.
On 1 April 2015, Diamond acquired 50 million of 6% listed bond at their nominal value. Diamond may sell or hold bond to maturity and so, based on this business model, has designated the bond as a fair value through other comprehensive income. The effective rate of interest on the bond is also 6%. The bond had a fair value of 42 million at 31 March 2016 and were correctly treated in the financial statement of that year. On 31 March 2017, Diamond received a coupon interest of 3 million, which was recorded within interest received, and then sold the bond on the same day for 35 million. The disposal proceeds were substantially below the fair value of the bond, which was 38 million at 31 March 2017. A 7 million loss on disposal was charged against profit. Diamond has an option to repurchase the bond at any time up to 31 December 2018 for 36 million. The fair value is expected to increase in the future, and it is highly likely that Diamond will exercise this option.
Okay. Okay. All right. So let's take it one by one. Okay. So Diamond acquired 50 million 60% listed bonds at the nominal value. So we are having 6%, 50 million bond at their nominal value. Okay. Diamond may sell or hold bonds to maturity, and so based on this model, it's always going to be under fair value through other comprehensive income. Okay. The effective rate of interest on a bond is also 6%. The bonds had a fair value of 42 million at 31 March 2016, and we are correctly treated in the financial statement of that year. Okay. There was a loss of 8 million in the first year, and they have done that. We are accounting for this in 2017. Okay. So they have done that already. The fair value was 42 million. Okay. On 31 March 2017, Diamond received a coupon interest of 3 million, which was recorded within interest received. Okay. So this is whether you are classifying the instrument through profit or loss or other comprehensive income, the interest that you are going to be receiving will still be an interest income. Okay. It is only the fair value. How do we treat the fair value? So it's the fair value that will be going to other comprehensive income. So that is okay for them. And then sold the bond on the same date for 35 million. Okay. And then sold the bond on the same date for 35 million. Okay. So the fair value of the bond at that date, the fair value of the bond last year was 42 million. So it means that the same year too, it will be 42 million. We are here to what? To incorporate what? The fair value adjustment. So The carrying value of the bond will be 42 million, but this has been sold for 35 million. All right, think about it. Something that is 42 million and something that is 35 million. Okay, under normal circumstances, can this thing happen? We are all being rational. We are all being rational. Nothing is happening to the bond. The bond is not that the company is not doing well, because we don't have any information about that. Okay, the company is doing well, everything is possible, and we are selling the bond for 35 million. That is 7 million below the market value. Okay. The disposal proceeds were substantially below the fair value of the bonds, which was 38 million. Okay. At that particular date, the time that we are disposing this particular bond, it should be 38 million. The fair value was 38 million. So if you want to sell, it's supposed to be at 38 million. But why are we selling at 35 million? We will come to that. A 7 million loss on disposal was charged against profits. Diamond has an option to purchase the bond at any time up to 31 December 2018 for 36 million. Okay. The purchase option is also lower than the fair value. The fair value is expected to increase in the future, and it is likely that Diamond will exercise this option. So if the fair value is going to be increasing in the future, we can also the bond will below its value. So we come to how we should do that. Okay, let's look at the bond, the treatment from the 2016 up to now. Okay, so let's come to initial recognition. Initial recognition. So we are going to be having a fair value of 50 million. So we have interest income for that year. Okay. So let's come to 2016, 31 March 2016. Okay. The bond will be, so we have interest. Interest will be, the effective interest rate is the same as the coupon. So 0.06 multiplied by 50. How much are we getting? We should be getting the 3 million. Okay. And the coupon.
3.
Okay. The coupon will also be 3 million. So 0.06 multiplied by 50. So you'll be having the 50 million again. But they say the fair value for that particular year was 42. Okay. There will be a fair value loss of it that has been accounted for already. So they say that has been accounted for in that year. Okay. So in the current year now, the fair value of our bond in the current year now, that will be 31 March. Okay, 31 March, which is the current year. So 31 March 2017. 31 March 2017. Okay, our fair value of the bond, the interest will still be calculated on the 50. Okay, so the interest will still be on the 50. The fair value, which is 42, is just the movement that we are looking for. But the interest will still be paid on the agreed amount, which is the nominal value. So that will still be 50-50. So we receive the interest of 3 million, but we are concerned about, so this one, let me do the carrying value at the beginning of this date. Carrying value will still be the 50. It is the 50 that we are going to be receiving the interest on. Okay, so we have the interest income to be 3. Coupon will still be 3. Okay, so interest will be addition, coupon will be a subtraction. So 3 and 3. So we'll be having 50. Okay, but there was a fair value loss last year. So our fair value at the beginning of this year is supposed to be 42. Okay, the fair value is just for the movement. Okay, which the person that is issuing the bond, he's not going to be taking the fair value into consideration. The bonds are issued at 50 million. So they will be paying the interest on the 50 million. It's used that you want to use a different accounting method to account for this. You want to make a provision for the for the what? For the differences in the fair value of the instrument. So they will still be having and be paying the interest on the 15 million. But your fair value at the close of last year is 42 million. Okay. So you'll be having a fair value of 42 million. Now, let's come here. Okay. Diamond received a coupon of this, which was recorded within interest received, and then sold a bond on the same day for 35 million. This has been recorded within interest received. So that is cool. It has been recorded already. Okay. And then sold a bond on the same day for 35 million. Okay. The disposal proceeds were substantially below the fair value of the bond, which was what? 38 million. Which was 38 million. Okay. All things being equal, if we actually want to sell the bond, how much should it be sold at? All things being equal, how much? How much should we dispose the bond for? If we actually want to sell the bond, if it should be actual sales.
42 million.
No. The disposal proceeds were substantially below the fair value of the bond, which was 38 million at 31.
Okay. So it should be 38 million.
Okay. It should be at 38, isn't it?
Mm.
Okay. But you are now selling the bond for what? 35 million. You are not giving a discount, no. It's not a discount. Okay. You have sold a bond below the market value. Okay. At the time that you are going to be buying the bond back to, it is below the market value again. So whenever a financial instrument is being sold below its market value, whenever a financial instrument is being sold below its market value, and you have the option to purchase, and that exercise price is also less than the fair value, the financial instrument is treated as you are using it as a collateral security to take loan. So the money that you are receiving from the person should be treated as a loan. So you are not disposing. If you are actually disposing, the disposal should be at the fair value of the instrument that you are disposing. We should dispose this particular bond at 38, not 35. Okay. So since you are disposing at 35, which is a value lower than what? The fair value. It is likely, okay, you are telling the person that, oh, I have money somewhere, so give me 35 million. I'll be able to pay you within this time. That is it. So whenever financial asset or any asset, it can be equipment, it can be any other asset, whenever they are being sold below their market value and you have the right to purchase it back, and the exercise price is also below the current market value, that particular disposal should be treated as a finance arrangement. It should be treated as a finance arrangement. We are not selling. We are just using the instrument as a collateral security to take loan from these people. So we have to reverse whatever transaction that has been done. Okay. So they have recognized the disposal for them. So we now have, what they have done is that they have done a disposal. They have done a disposal of, okay, so they have done a disposal of 35 million, and they are having a loss of 7 million. Okay. So this loss will be recognized. This loss will be recognized in what? Retained earnings. Okay, there should not be any loss. Okay, there should not be any loss in the first place. So we go and we reverse this loss for them. So we have a reversal of loss on the financial assets. That will be, it has been subtracted. So we reverse it by adding this back. Okay. Okay. If this has not been disposed, if there was no disposal, what's supposed to be the fair value of the instrument?
38.
38. Okay. So it was 42 and now it is 38. So it has reduced by how much?
That's 3.
42 against 38.
4.
Okay.
4.
Okay. There will be a fair value loss of 4. Okay. So let me just do this one. Let me just do everything. So it means that the 42 has been subtracted from this place. No, bring it back. Okay. The 38 million should be 38 million should be treated as a current. The 35 million that we have received should be treated as a loan. Okay. Because of the exercise date, this amount is going to be paid soon. Look at the time that you are going to be buying the instrument back. Okay. The company has a repurchase to 31 December for 36 million. So it means that this amount will be paid within what? Within a year. So 35 million should be treated as a loan. Okay. We reverse the 42 million because we are reversing the what? The cash together with what? With the loss. So we should have the cash as a liability, and we should have the 42. There should not be any loss, so we have reversed the loss also. So the entries that we have done over here is to debit the other financial asset with the 42, credit liabilities, credit retained earnings. So we are having the 42 as a figure. Okay, so we have reversed what they have done now. Okay, the question is, if there was no disposal, the bond should be fair valued again. So the bond should be fair valued to their actual fair value at the reporting date, which is 38 million. So from 42 to 38 million, there will be a fair value loss of 4 million. So you go there and you take away your 4 million fair values from this fair value loss, and this will now be taken to other components of equity. So we have the fair value loss. Fair value loss will give us 42 minus 38, and that will give us 4, because we are classifying the instrument to other comprehensive income. So that will go to other components of equity. Yeah, I'll take it again. Whenever asset is being disposed substantially below its market value, no discount is given. The asset is in a good condition, and you also have the option to purchase the asset back. But the exercise price is still below the fair market value. This is treated as a finance arrangement. Okay. If you are actually buying the asset back, then you should have to buy the asset at an amount higher than the current market value. You should actually purchase the asset at an amount higher than its actual market value. Or if you're actually selling the asset, it should be sold at existing market value, because if you sell it to the market, that is the amount at which you are going to be selling it. But you are selling it below that particular value. It is seen as you are using the asset as a collateral security for taking a loan. So the amount that you are receiving should be treated as a loan. Okay. And you still keep your asset in your books. That is it for this particular one. Okay. So let's move on. We are done with that also. So we have to move on. All right.
F. Diamond operates a defined benefit pension scheme. On 31 March 2017, the company announced that it was to close down a business division and agreed to pay each of its 150 staff a cash payment of $50,000 to compensate them for loss of pension arising from wages inflation. It is estimated that the closure will reduce the present value of the pension obligation by $5.8 million. Diamond is unsure of how to deal with the settlement and curtailment, and has not yet recorded anything within its financial statements.
Okay. So this is about employees' benefits. Diamond operates a defined pension scheme. On 31 March 2017, the company announced that it was to close down a business division and agreed to pay each of its 150 staff a cash payment of what? 50,000 to compensate them for loss of pension during arising from wage inflation. Okay, so let's look at how much they are going to be paying to each of the staff. Okay, that might be the starting point. So what is a compensation, which we call the settlement? So they have to settle there. Okay. So 150 multiplied by 50,000. Is that correct? The amount that we are going to be paying to the total
Yeah.
number of 150. Okay. Each of them is being paid 50,000. So agree to pay each of its 150 staff a cash payment of what? 50,000 to compensate them for loss of pension arising from wage inflation. Okay. So let's come to that side there. Okay. How much are we getting? If each of them is taking the 150 multiplied by 50,000. Okay.
7.5.
Okay. We're having 7.5 million. Okay. Okay. So this 7.5 million, okay, it is estimated that the closure will reduce the present value of the pension scheme by 5.8 million. Okay. A reduction in our liability, a reduction in our pension liability as a result of what? Restructuring, or as a result of you maybe laying off some of your staff, is what we call the curtailment. Curtailment is just a reduction in our pension obligation as a result of what? Restructuring. So if some people are leaving, if we are now doing restructuring, we are now sacking some people, what is the effect on our pension obligation for the people that will be what? That will be existing. They say that it is reducing our pension obligation by 5.8. Obligation is a liability. So if your liability is reducing, that is a gain to you. Okay, so we are going to be incurring a cost of 7.5. It's a cost. We are going to pay those people. So that is a cost for us. But this particular reduction is also costing what? 5.8 million reduction in a liability. Okay, so if that is having a reduction in liability of 5.8, the meaning is that we are having a gain of, so you have a curtailment gain. Okay, curtailment gain of 1.5 million, of 5.8 million. Then what will be the net amount? What will be the net amount? What will be the net expense? The net cost?
1.7.
Okay, so this 1.7 is the net expense. Or if you like, you can do the two like this. Okay, you can go to retained earnings. Then you have the settlement cost. Okay, you have the settlement cost. Okay, settlement cost, you have the 7.5. So you bring the 7.5 here as a reduction. Then you also bring your curtailment, the curtailment gain here. Curtailment gain as 5.8. At the end of the day, you'll be having your net expense of what? Of 1.7. Okay, let's now come here. They say they are here to recognize this, so we have done that particular part of it. But let's come. Okay, the people, the 150 people, have they been paid? The 150 people, have they been paid?
No.
Not yet.
They have not been paid. Okay. So we cannot also assume that we are going to be paying them at that date. So it means that we are going to be having a liability arising from this transaction. So you can come and add to your current liability 7.5. Okay. The reduction in the pension obligation, has that also been taken into consideration?
No.
Okay. Where do we have the pension obligation? Is it going to be current
Just,
or non-current liability?
just non-current.
Okay, so you come here and subtract your 5.8 as a reduction. This has not been recorded. So we haven't paid the people, but if you also assume that the company, the people have been settled immediately and you have taken this one from current asset to, there's no problem with that. Okay, because they say they are going to be paying them in cash. So paying them in cash at the reporting date, you can assume that they have actually been paid at the reporting date, but the transaction has not been recognized. So you go and subtract your 7.5 from your current assets. Or you say they are yet to be paid. It means that the company will be owing them 7.5. That will be a current liability. Our different obligation has not been what? Has not been touched. So it means that 5.8 has not been taken away from it. So you also take the 5.8 from your non-current liability, representing a reduction in the defined obligation. So that is it. Match your cost against your what? Your income. The net amount will be sending to statement of asset statement, retained earnings. All right. Let's look at the last one. Then we see.
On 1 April 2016, Diamond acquired a manufacturing unit under an 8-year finance lease. The lease rental have been recorded correctly in the financial statement of Diamond. However, Diamond could not operate effectively from the unit until alterations to its structure costing 6.6 million were completed. Please let me take it again. On April 2016, Diamond acquired a manufacturing unit under an 8-year finance lease. The lease rental have been recorded correctly in the financial statement of Diamond. However, Diamond could not operate effectively from the unit until alteration to its structure costing 6.6 million were completed. The manufacturing units were ready for use on 31 March 2017. The alteration costs of 6.6 million were charged to administration expenses. The lease requires Diamond to restore the unit to its original condition at the end of the lease term. Diamond estimates that this will cost a further 5 million. Market interest rate is 6%.
Okay. All right. So this is about PPE and at the same time about provisions. Okay. So we are saying that on 1st April, Diamond acquired a manufacturing unit under 8-year finance lease. The lease rentals has been recorded correctly in the financial statement. So it means that the amount that we have paid for the lease has been recognized correctly in the books. Okay. Okay. Diamond could not operate effectively from the unit until alteration to structure costing 6.6 million were completed. The manufacturing unit was ready for use on 31 March 2017. The alteration cost of 6.6 million were charged to administration expenses. Should these be charged to administration expenses?
No.
No, please.
It should be charged to what?
It should be capitalized.
Okay.
Yes, capital expenditure.
Okay. This is a cost that we are incurring to bring the asset to a state that it will be ready for use. Okay. Without this particular cost, the asset can never be ready for use. So this is a capital expenditure, and this is also the initial cost of bringing the asset to the state that it will be used. So what we do is that we have to capitalize it. So let's go and clear that one first. Okay. So this has been charged to. So we come here and have our 6.6. Okay. That has been charged to administrative expenses, means that it has been charged to their retained earnings. So you come to alteration cost. It needs to be reversed. Okay. So that will be reversing, means have to be added. It has been taken away. It has been taken as an expense. So you have to reverse that particular portion. Okay. Let's come here. The lease requires Diamond to restore the unit to its original condition at the end of the lease period. Diamond estimate that this will cost a further 5 million. Market interest rates are currently 6%. Are we giving any information about this being recorded? What are the recordings that have been done? What are the transactions? It is a lease and also the alteration cost, isn't it? Okay.
Yes.
Nothing has been given on this particular provision. So it means that they are here to make the provision. The question is, when should we start recognizing the provision? When should we start recognizing the provision? Will it be the time that the asset has been leased, or it will be the time that the asset is ready for ready for use?
Ready for use.
Okay. So your provision, you start making a provision from the time that the asset will be ready for use. It means that that is the time that you are going to be using the asset. You are now certain that you are going to be using it, or you have done every installation and you are going to be using the asset. So you actually, I mean, it's
Hello.
all right. So the provision will be made from the date that the asset is ready for use. Okay, you have the asset for eight years. Okay, you are leasing the asset for 8 years. But it can happen that you are not going to be doing any installation. So you cannot cancel the lease. It can be non-cancelable lease. Okay. And you have to do some installation, some things there that will be requiring the dismantling. But you are now saying that you're not going to use the unit again. It means that there will not be any installation. And since you are not putting any equipment or any plan there, you are not going to be doing any dismantling, you are not going to be doing dismantling. Okay, so it means that you can use the asset for 8 years without dismantling, because no plant or equipment has been mounted or has been installed there, which will be demanding dismantling or an installation at the end of the lease period. But since you are now saying that you are going to be using it, it means that, okay, everything is now in place. Machines and those things has now been installed there, so you can start using it. So the provision will be made for 7 years. Okay, because the asset is ready for use on 31 March 2017, but our lease was on 1st April 2016. So it means that we have done 1 year. The first year, the asset was not ready for use. So the asset is now ready for use on 31 March. And from April 2016 to 31 March is 1 year. So we have done 1 year of the lease already. So remaining 7 years. So the provision has to now be made for the remaining 7 years. So we have to go and make a provision for this particular one. So let's look at the provision. How do we make this provision? Very simple. So you have your 1 divided by 1.06 exponent 7 multiplied by the provision cost of 5 million. Okay. So you find the discounted factor, the discounting factor, and multiply it by your amount. Okay. So that will be 1 over 1.06 exponent 7 multiplied by 5 million. Your discounting factor should be to 3 decimal places. What are we having? Right.
3.325.
Okay. So we have 1 over 1.06 exponent 7 multiplied by 5. Okay. So if 3 decimal places, what are we having for the discounting factor?
0.665.
Okay. So let me just do the 0.665 here. So 0.665. Okay. So 0.665 multiplied by 5. So I'm having 3.325. Okay.
Yes, please.
If we are doing provision for dismantling costs, how do we treat it?
It will go to liabilities
And
PP.
okay, so we debit the PP 3.325 and credit what provisions. These provisions will be included in non-current liability because this will be for 7 years. So you go to your 3.325 and you come to 3.325. Okay, so you can now find your post-acquisition profit. What is the post-acquisition profit for these people? 720 plus 780 plus 64 plus 36. I'm having 1,600. Plus 880 plus 70 plus 36. I'm having 1714. The difference will be what?
One 4.
It will be 114.
114.
Okay, that 114 should be shared among the portion that is for retained earnings and the portion that is for the other component of equity, because the parent will be taking each share of the other component of equity to their other component of equity. Because you can see that, how did we get a net asset figure? It is, we have added the capital items, the normal profit items, and also the other comprehensive income items. Okay, let's count to other component of equity. What is the increase in other component of equity for the subsidiary?
14.
It's 14, isn't it? Okay, so we make this one to be 14. Look at the retained earnings. What is the increase in the retained earnings? That will be 100. Is that correct?
Yes.
Okay. So the parent will take each share of the normal profit items to retained earnings, and they will take each share of what? Of the other comprehensive income items to their. So let's come here. We have the share of profits, which will be, the parent will be having 0.7 multiplied by 100. That will give us 70. If we count to other components of equity, share of OCE of that particular subsidiary, the parent will be having 0.7 multiplied by 14. What is that? I'm having 9.8. Okay. But what is going to happen is that NCI will be taking their share. So NCI, all of their share will come here. So share of this one, NCI will be having 0.3. Okay, 0.3 multiplied by the retained earnings together with the other component of equity. So you can just do the NCS share of all the total. 0.3 multiplied by 114. Okay, I'm having 34.2. Okay, so let's come to the net asset figure for these people. Okay, I'm sure this will be 1062. And this will be how much?
1131.
1131. Okay, so 1131. The difference is what?
69.
Okay, that's 69. Would there be any portion for other components of equity?
No.
Because it's 9 against 59. There is no increase there. So we have retained earnings to be 69. So this is 59 against 59. There is no increase there. So this 69 is for holding the profit or loss. So NCL will have their share over here. That will be 1.15 multiplied by 69. The parent will have their share of P8P for club. That will be 0.85 multiplied by 69. So I'm having 58.65. $10.35. All right, so you can just put your figures together. All right, so let's look at the cash flow.